Great, thank you. And hello, everybody. I'm excited to have the chance to talk about on-bill financing / on-bill repayment programs. I'm here today to provide the overview of these programs, lay out some of the opportunities and challenges that come with them, and to give brief snapshots of a few programs from around the country before I turn it over to deeper program dives from my co-presenters. Next slide. But first, just for a little bit of background, I'm with the Environmental Energy Study Institute. We're a small nonprofit based in DC. While we have focused mainly on nonpartisan federal policy education on clean energy issues for the past 6 or 7 years, we've been running a project that works at the more local level, aiding smaller utilities to help design and launch on-bill programs. Some of you might have met our executive director, Carol Werner, at the recent meeting in New Orleans. Or my colleague Miguel Yanez, who presented at several of the regional meetings earlier this year. And I'll just say that for those who did, I promise that I have mostly new slides. Next slide, please. Okay, so on-bill. At its core, it is basically a program where a utility of any kind finances or facilitates third-party financing of some type of benefit to an individual customer. And then that customer repays the utility over time as part of their monthly bill. These programs leverage the existing utility customer billing arrangement so that customers can conveniently pay in installments for some additional opt-in benefit. You can have an on-bill program to help pay for water service upgrades or improvements, energy efficiency upgrades, appliance replacements, rooftop or community solar, energy storage, list goes on. Preferably, your program is one that lowers the participants' energy or water bills, creating savings that help at least partially offset the cost of the monthly repayments that are part of the same monthly bill. And let me add that we're going to focus today on the most popular application for on-bill, which is to finance energy efficiency upgrades to homes and other buildings. On-bill is an extremely flexible tool and not a new one. We know of at least 60 programs in 22 states, some that have been going for 30+ years. They come in all shapes and sizes. Some older programs are not about clean energy at all, but are just a way to finance a furnace replacement or install new load, like a pool heater even. And I point this out to say, maybe your past experiences with or knowledge of on-bill programs might be limited in some way, built around one or a few programs that don't show the full breadth of the tool. These 60 programs show many different ways to design and run programs in ways that achieve different goals or best fit the needs of a specific utility in a specific state. Some programs are run or designed better than others, sure, and we'll try to capture some best practices for you today. But many of these best practices are program evolutions that have emerged in recent years that revolve around getting bigger per home savings to a wider segment of communities, including underserved populations, which I'll get to those best practices in a bit. Next slide. So this slide is to hammer home the basic function of the on-bill mechanism, namely that your energy savings and repayment for the upgrades are all happening on the same bill. I'm using here an actual example from an on-bill pilot run by the South Carolina Electric Cooperatives, which looked at the savings of their 125 pilot participants 1 year later. This graph shows how the cash flow worked out for the average participant. The average home saved $1,160 that year, which was slightly adjusted for weather normalization. The average loan payments add up to $870 a year, which left $290 in net average annual savings. And this is the good stuff. A program that delivered on its design to be at least bill neutral for its participants, meaning that the average monthly energy savings are equal to or greater than the monthly loan payment, giving the participant a positive cash flow even while repaying the utility. And then when the loan is paid off, 10 years in this case, the savings skyrocket. So by aiming for bill neutrality, you can really open up your program design options. Next slide. So one of the things I was asked to do today was explain the difference between on-bill repayment and on-bill financing. The possible subtitle for this section could be, I use the phrase on-bill financing for years in a way that it's technically incorrect, still sometimes do, and mostly don't really care. So with that, on-bill repayments, or OBR. I've created a diagram here that shows a sample model for OBR. The asterisk, by the way, is to say that this is a stupidly simple sample model, which I'll get to in a bit. In general, OBR, the utility customer that participates in the program, receives, the utility customer that participates in the program receives financing from some type of capital provider. So basically like traditional financing. This could be a bank, a CDFI, credit union, something along those lines. But the participant doesn't repay the bank directly, but instead the utility collects the repayments on the bill, then passes through those payments back to the bank. And you might ask yourself, why even bother using the utility as a middleman? Well, that's a complicated answer, but the short version is that there are fewer defaults or other non-payment issues with an on-bill program as opposed to traditional financing. Next slide. So now on-bill financing, or OBF, here the utility is supplying the capital to the participating customer. The utility is doing the financing rather than facilitating repayment to the bank. And that's basically it. The utility still has the option to go to the capital provider and borrow program capital rather than use its internal funds. This can open the door for capital providers, including certain state and federal programs, that would only be willing to provide a lump sum to the utility rather than process each individual participant. Next slide. And so here are the two sample models side by side. The biggest difference between OBF and OBR is going to be whose forms the customer is signing, how the money flows in and out of the utility, and who ultimately deals with the customer that fails to pay, which are not insignificant things, I know. And it may impact program design choices. Your state laws might have plenty to say about one of the models and not the other. But the differences between the two are, in my opinion, basically immaterial to the opportunity that can be given to the utility customer. They and the contractors don't care how the money flows. And at these terms, financing is still happening in on-bill repayment, and repaying through the bill is happening in on-bill financing, which is another way of saying, I just learned to call them all on-bill programs, and my life was simpler. If I could add just a bit more about these being simple sample models, again, 60 programs. The flow charts for each would look very different from one another if I did one for each. In many, contractors are paid directly by the bank or utility, and the customer never holds the capital. In others, the utility hires a third party to administer parts or all of the program. Or the utility is drafted to provide payment pass-through while the program is driven by a state agency or a nonprofit. Some on-bill programs contract with financial institutions to handle loan origination and processing. The list of exceptions goes on and on, meaning don't put too much weight into these flowcharts. Next slide. Now on to what is perhaps a more important classification for on-bill programs, loan versus tariff. Loan is probably the more straightforward one. The participating individual signs a traditional loan agreement, which they repay through the bill. With a tariff, the participant agrees to a voluntary cost recovery charge that is attached to the utility meter in exchange for the program making the energy improvements to the property. There is an agreed upon repayment schedule, but no loan document. This is the approach, by the way, that's used by the pay-as-you-save program, which is very popular. Because the tariff charge is attached to the meter and not the individual, that means that the charge stays with the property even if the occupant moves out, meaning that the remaining payments must be made by the next occupant. And for that reason, tariff programs need to aim for bill neutrality, so the next occupant is likely paying less than they otherwise would have been if no improvements had ever been made. And then to complicate things, there's a third option, the hybrid option, which is a meter-based loan. And so here the participant signed a loan agreement, but the loan stays attached to the meter and is transferable, just like the tariff. This hybrid approach is actually the one that I've had the most experience with. Next slide. So then a little bit about the opportunities and challenges that we see with on-bill programs. And I'll try not to generalize too much from one program to the next. But just some of the opportunities that we see, that one of the reasons that we've really gotten behind the idea of on-bill programs. One is that this is a way to reduce barriers to clean energy programs, especially those kind of gap populations that can't use normal programs or traditional programs, but also don't aren't able to access WAP and other low-income programs. This is a way to provide deeper energy savings than, say, a rebate program, potentially. We see, in general, low risk of defaults. And it's also, because in general, it's a more hands-on program for utilities. The customers see that happening. They really like it. And this leads to improved utility customer relationships. And some of the co-ops in particular that we've worked with really love that angle. But there's challenges for sure. I'm sure some of these are ones you're already thinking of. I'll do my best to address some of them, but where does the money come from to begin with? Can the utility do something like this? I mean, it's a little outside of what a lot of utilities do. Do they have the capacity for it? There was a number of programs in the 70s, 80s, 90s that went away for a variety of reasons, but one was utilities just deciding it was too much work, and maybe that's the story you've heard before. What we have found is in recent years, there's been a lot more models of collaboration. So utilities do some of the work, but then they partner with third parties that do other things more efficiently, and that they the workload shared a little bit, and that has led to more robust programs that utilities find easier to manage. Contractors can be a challenge. Maybe it's a matter of, do you have enough of the right kind of contractor in your service territory? Does the utility want to really get involved with the contractors? There are some programs that the utilities work closely with the contractors. There's others where that's totally hands-off. So there are workarounds. What we see as a bigger challenge sometimes is just, are there contractors that can serve that territory, especially say in a co-op, which has a lot of ground to cover. And then this last one, I hear it plenty. We don't want to be a bank. And some of this originates from some memos that circulated a couple years ago saying, if you're a utility that's going to run an on-bill program, there's a chance you're going to be regulated like a financial institution, which we haven't really seen any real evidence of. But to get back to my point about utilities finding partners with other institutions, there are ways to say partner with a lender, even if you're doing an on-bill financing program, partner with some type of financial institution where the bank-like entity is doing the bank-like tasks, and the utility can focus on other parts of the program, and that's can be a best of both worlds situation. Next slide. So while I don't want to go into detail on all the opportunities and challenges, I did want to highlight one of each a little bit more. First is the opportunity to reduce barriers to clean energy programs, or if you will, expand access to clean energy programs. One of the great aspects of most on-bill programs is that it provides a viable alternative for homeowners who can't afford the upfront costs of upgrades and therefore can't make use of rebates or tax incentives. Many programs use alternative underwriting criteria to give people access to financing that might not have a viable credit score. And what they do is they look at the bill payment history instead. The thinking goes, if you've paid your utility bill in the past, you've made that a priority, then you will keep doing so even with the extra charge on the bill. And on-bill programs, especially ones that use this technique and also focus on bill neutrality, have generally seen low default rates. And then also this idea of transferability that I brought up earlier. If you do that, you can look at the possibility to open the door for renters to participate. Not a lot of programs do. We've seen a couple do it with some success. It's something we'd definitely like to see more of. Next slide. And then one of the challenges I wanted to quickly address is this question of, where does the loan capital come from? In short, a little bit all over the place, though I acknowledge that many of these options might not work well for utilities in your states, including having a willing local financial partner like a CDFI. Those are great if you can find them, though. USDA offers low to no interest options for rural utilities, but those are not the most nimble of application processes, to say the least. And I wanted to mention this last one, the large capital providers. That has not happened yet. It's an ongoing conversation. I think it will happen, but not necessarily in the near future. Next slide. So this map shows in green where on-bill related authorizing legislation has passed in, I believe, 13 states. This comes from the National Conference of State Legislatures, which has this great on-bill webpage that has links to all of the bills. And then the yellow on the map shows states where on-bill programs are operating or have operated without explicit authorizing legislation, though many went through the regulatory approval process. So all this is to say that every state has a unique set of laws to navigate, but that many utilities have been able to set up programs that can operate within existing state law. Next slide. So I'm just going to quickly round out things today with snapshots of 3 programs, one slide apiece, I promise, and I'll just try to zip through these. First up is Help My House on-bill program run by 5 co-ops in South Carolina, which I mentioned earlier. The program is ongoing, but though my best data is for their 2011 pilots, the average pilot home saw 34% energy savings, or about 11,000 kilowatt hours per year, through whole house measures that cost about $7,700 on average. All electric homes, about half of which were manufactured homes. The co-ops created a nonprofit to handle capital and the meter-based loans, which were approved through good bill payment history, which then they saw very few defaults. The loan capital, by the way, has all come from the USDA Red Leg program, and that the Help My House was recently awarded a $13 million zero interest loan from USDA's Rural Energy Savings Program. The co-ops are fairly hands-on with this program. They work with their members to develop a work plan for each home, provide a list of approved contractors, approve the work before contractors are paid, and generally make the participating members feel comfortable in the process. As a result of that and the bill savings, the co-ops got a really positive response from the participants, and some came to the annual meetings to rave about the experience. That improved customer relationship. It's not something you're going to get from a rebate program, right? And we've seen it as a driving force in a lot of programs. Next slide. Next up is Seattle City Lights on-bill repayment program, which has been around since 2011. Also makes use of transferable meter-based loans. This is a collaboration between the Seattle Muni and Craft 3, local CDFI, and they also run similar programs with other Washington utilities. The program, and these numbers are I think a year or two old, I've done about 400 projects, has seen 25% energy savings. And one interesting feature is that this program looks at credit scores, but will forgive lower range scores if the applicant has a good bill payment history. And I don't believe, last I checked, they have had any defaults. Next slide. And last is Midwest Energy, an electric and gas cooperative in Western Kansas. Their program, House Smart, is a tariff-based on-bill program that's operated since 2007. As of a year ago, the program had invested $9.7 million into 1,670 projects with significant savings that you can read for yourself. They require the applicants be current on their bills and that the monthly repayment must be 90% of estimated monthly energy savings, got that, to help ensure bill neutrality. And if math doesn't work, then the participant can pay up front to bring the remaining costs down to that 90% figure. And this program's default rate is less than 1%. Next slide. Okay, this is it for me. I just wanted to close by letting you all know about EESI's ongoing initiative. As I mentioned, we can work with utilities to do anything you see there. While we function like consultants, our work is grant funded and is therefore free of charge to the utilities. And with that, just thank everybody for the time, and I'll turn things back over.
All right, thank you so much, John Michael. That was great. In the interest of time, and just to make sure we can get all our speakers, we're just going to hold Q&A until the end of the session. If you do have a question, please either use the raise hand feature, or you can type it into the question panel and send it to myself, and we'll announce the questions at the end. So now we're going to turn things over to Mary Templeton, who's going to provide us with the Michigan perspective on their statewide on-bill finance program and that stakeholder process they've used. Mary, are you there?
I am here. Can you hear me?
Yep, and I've sent over the presenter to you.
All right, I think we should be good to go. Can you see my screen?
Yeah.
All right, great. Well, thank you, Sam. I appreciate the opportunity to talk to this group. And John Michael, great overview of on-bill programs. We have also started to use the on-bill programs terminology. It's just a lot easier to put everything into one category from our perspective. But I'll make a distinction between on-bill repayment and on-bill financing as I can as I go through my presentation. I thought it would be really helpful to give just a very quick background on who Michigan Saves is, because I think it will give you the perspective of what we, as we transition into the on-bill piece. But we're a nonprofit organization. We were really set up as a private-public partnership, initially with funding from the Michigan Public Service Commission, and then subsequently with funding that flowed through the Michigan Agency for Energy from the Department of Energy in ERA days. That funding allowed us to do a lot of stakeholder engagement to figure out where the gaps were in the marketplace with energy efficiency and renewable energy financing. And what we found through that research was that there were plenty of capital providers to provide the capital, and there was plenty of contractors to actually do the work. What we didn't see was anybody putting it all together into a program that really served the needs of energy efficiency and renewable energy financing. So the structure that we set up was a structure that used that initial grant funding not only to do the stakeholder work, but to set up a loss reserve that backs the loans in case of default. We've created a residential, a commercial, a public sector, and a multifamily program. And since our inception back in 2010, we've now financed through our private capital providers more than $100 million in loans, which we're super excited about. And we've had very, very few defaults. Less than 2% of our loan value has defaulted. I'm going to focus, and hopefully you can see this whole thing, but I'm going to focus on the home energy loan program. About 75% of the loans that we've issued so far have fallen into this bucket, and the on-bill work that we're doing is in the residential space, so I will focus on that. And the perspective that I start with is, you know, this home energy loan program, this HELP program has been running now for 7 years. We've done $75 million. We offer really great rates and really great terms. It's super easy, super affordable. Loans can go up to 30 or even in some cases 50,000. We can finance for up to 10 years. The rates start at 4.25%, and it's contractor driven. So the contractors are offering the loan when they're speaking with their customers. They call a centralized loan center, and the loans get approved right there on the phone, so the contractors can complete their negotiation with the customers, and then they do the work, and then we fund it from there. But it's been a really, really popular product, and the contractors have loved the opportunity to offer longer terms and great rates, and an unsecured product that doesn't really have to go through like a home equity loan program or something like that. But with that perspective, as we started to, shoot, my screen is not moving. There it is. I already talked about that the current product is really easy, it's really affordable, and the stakeholder engagement process was the process that we used to create the program. So as we turned our heads to and our minds to creating a statewide on-bill program, we used the same stakeholder engagement process. And that's really what I want to talk about today. But before we get there, John Michael talked about some of these gaps in the marketplace that on-bill addresses. And with our unsecured product, it is very popular and it's doing really well. However, it doesn't serve all of the marketplace. And I'll just give you a metric that I think is really important. We approve about 75% of the applicants that apply. It is credit score based, so we do go down to 600 now, but you have to have a debt to income ratio of at least 50%. And so there are still, 25% of the people who are ready to make a move on installing energy efficiency work are not able to be served with this financing program. And so we think that there is a gap that could be served with people that maybe don't qualify for traditional loans. The other thing is our lenders currently go up to 10 years, and we think that we can make it a little bit more affordable by going to 15 years, which some of the on-bill programs can be allowed to do. We don't serve the rental market at all. We serve multifamily housing, but it's to the multifamily property owners, not to the tenants. And so we think that that's an opportunity for renters to participate in energy efficiency improvements. And then you also see homeowners who may end up maybe thinking that they don't want to invest in the more efficient HVAC system because they know they're going to move, but what if they could transfer that obligation to the next owner? They may be more likely to invest in the high efficiency programs. And then of course there's an ease factor that we assume is relevant in the marketplace. So with those gaps, we thought, well, what is our role in this? And as a statewide financing entity, what is it that we can offer, and why would we do a statewide on-bill program? And when we looked at Michigan, you see there are so many complexities to our utilities. We have over 50 utilities. They're rural electric co-ops, they're municipalities, they're investor-owned. There are many territories where there are gas providers that are different than electric providers. And as we did our stakeholder engagement, we found one of the things that John Michael mentioned, many of the utilities that we talked to, they don't want to be financing experts. They don't want to be bankers. They don't want to be subject to lending regulation. So we thought, what if we engaged a bunch of stakeholders and explored that possibility of creating a statewide program that would be consistent for any utility that wanted to opt in. And our premise is that it will create economies of scale, and it will lower the administrative costs and make implementation that much easier. So what we did was worked with can you hear me?
Yeah, we can hear you.
Okay, so my program is getting, there we go. So what we did was we did a couple of things. First of all, we worked with a number of experts. We researched best practices. John Michael, thank you very much to EESI. You were instrumental in helping us with our work in the city of Holland. There was some legislation that was passed in 2014 that allowed municipal utilities to finance, to set up on-bill programs. Subsequently, in 2016, legislation was passed to allow investor-owned utilities to finance energy efficiency improvements. But with these experts, we researched best practices, and then we partnered with the City of Holland to develop all of the goals, the program structure, the program design, the financing structure. And they, with our assistance, with the assistance of EESI and a number of other partners, launched the program in October of 2016. So it's been running for almost a year now. Our metrics through the end of July are that 28 projects have been completed. Their average loan value is $14,000, which is interesting because all of the work that we've done in our unsecured program, our average project is size is $10,000. One of the things that they allowed people to do is to finance up to 15 years. Of the 28 projects, 9 of those have financed for 15 years. The rest of them have done the 10-year term. The City of Holland is really delighted with the results so far. They're continuing to invest in it. The City of Holland's program was funded through internal capital, so it's a hybrid approach, but it is more like on-bill financing than on-bill repayment. They used capital from the municipally owned utility to fund the loan capital, and they issue their own loans through a nonprofit organization set up called the Holland Energy Fund. So we helped them create that entire structure, and then what we did was we used that same stakeholder engagement process that they used to conduct stakeholder interviews with many other utilities throughout the state. We held at least 2, if not 3, educational sessions with utilities, with contractors, with lenders, to kind of give them a sense for what's required to set up an on-bill program. And then what we did was we created a work group where these stakeholders came together and we said, you know, if we're going to build a statewide program, what we'd really like is your input on what is it that we should focus on from a goal standpoint, and then the program design to support those goals. We had that first stakeholder meeting in May, and what we did to get to a consistent goal was we reviewed the legislation. So there were 2 sets of legislation where were passed. We talked about those. We talked about lessons learned from other states. And then another thing that we thought was really, really helpful is we issued a survey to the attendees before they came, and we basically asked them, what's important to you? And we went through maybe only 10 questions, but we said, you know, what's your highest priority? Energy efficiency, renewable energy? Is it water efficiency? What is your opinion about the gaps that need to be served with an on-bill program? And just kind of went through some of the different program design elements that may or may not cause a little bit of tension between different goals. So for example, you know, did utilities want to allow the electric service or gas service shut off if somebody didn't pay their bill? And we went through all of those different things. And then we put those, we kind of deciphered those, put them up on a screen, and put a straw man of goals together, and went through that, kind of facilitated a discussion about, here's some of the goals that we heard from the survey, here's some of the implications on a program based on those goals. What do you think about that? And as we went through that discussion, it was a pretty lengthy discussion. It took us a whole day to get through it. But at the end of that first meeting, what we came up with were these goals that and we came to a consensus on those goals. And so the way that, you know, there are a lot of different ways to approach it, and I think John Michael alluded to that. But when we think about like our role as a statewide financing entity, we think that a stakeholder-driven approach is really, really good, and identifying the goals up front really helps us to drive that program design. So the stakeholders agreed to maximizing energy waste reduction per household, expanding access to people who may not be eligible for other programs, so really serving those, filling in those gaps that are not available to individuals in the marketplace right now, and then making it more affordable for homeowners. We did limit our discussion to residential programs. So then from there, we came up with these guiding principles to design the program. So there are a lot of different aspects to designing the program, and we're not all the way there yet, but some of the guiding principles are that we wanted to make it simple. We wanted to address the gaps. The utilities were really clear that they did not want to provide capital, so we have to create a program that's viable for capital providers, and then leverage existing resources, and of course meet the goals. So Stakeholder Meeting Two, what we did was we put together, once again, a straw man on program design elements that supported the goal, and we went through all of the discussions about eligibility and audit requirements, and what kind of a loan is it, what kind of interest rates are going to be acceptable, are there any credit enhancement, what do your capital providers look like, what kind of billing cycle, can we come up with a monthly billing cycle that's consistent amongst all of the utilities, who might be a program administrator, how are you going to manage the contractors, all of those things that are really, really complex that I'm making sound maybe simple, but they're not simple. And all of the utilities had many, different ideas about what might or might not work. So we gained consensus where possible, and then we identified the next steps, which basically are to work with a couple of the utilities within the state launch a program that matches the goals, that has the design elements that we could come to consensus on, and then from there roll it out to other utilities with kind of an opt-in handheld program. And finally, just as we think about working with a single utility or maybe two utilities to have this, to launch this program, these are some of the kind of guiding principles that we are abiding to, just because of the experience that we've had in the marketplace, that, you know, we definitely want to meet the program goals, but we also have to make it simple and efficient. One of the things that's really, really key, in my opinion, to a successful program is making sure that the contractors are being, you know, they're the ones that are working in the homes, and they really need to be involved in the process. The loan approval process, sometimes not so easy, but we'll make it as easy as we possibly can. And then the minimizing the paperwork burden on the contractors. The contractors tell us that over and over and over again. With the statewide program that we intend to put together, we just really want to reduce the complexities and eliminate the customer confusion, especially if you think about, you know, you're in a home and you've got a gas utility and an electric utility. What if they offered the same program and you could finance whatever it is that you want to, whatever improvements that you want to make, regardless of which utility you use. So I think I'm going to stop there, Sam, and I think my time is up, and I will allow you to take back the controls.
All right, thank you so much, Mary. That was great, very, very informative. So now we're finally going to turn things over to Jeff Pitkin from NYSERDA. Jeff, are you on the line?
I am.
Great. I'm making the presenter right now, and feel free to get started whenever.
Okay, great. Good afternoon, everyone. Jeff Pitkin from NYSERDA. I'm going to provide an overview of our on-bill recovery financing program. Our program was created through legislation that was signed by Governor Cuomo in August of 2011, and it built off of earlier legislation enacted in 2009 that created a Green Jobs, Green New York program, where, among other things, at the end of 2010, we launched an unsecured consumer loan product for energy efficiency improvement, paid back through a traditional kind of direct pay arrangement, not through the utility bill. So the 2011 legislation directed us to work with the New York utilities to establish a program, and we launched that program early after a period of about 5 months of working with utilities through the processes and systems to launch. The on-bill recovery financing program is limited to property owners, and I'm going to focus most of my discussion on the residential sector. So there, the maximum loan limits were established under the legislation to be not more than $25,000. The borrower has to be named on the utility account. Some of the features of our program: it is a statewide program. It's offered through our 6 investor-owned utilities and also our state utility, the Long Island Power Authority. It is not utility funded, it's on-bill recovery, back to as John Michael summarized. And ultimately, our program has been funded through capital markets, which I'm going to describe later. Our program, the installment charges are a tariff obligation. I don't mean that to be the same definition that John Michael said of a tariff charge that stays with the meter, but I just mean it to say that the legislation authorizes that the charge is treated the same as any other utility charges that are billed to the customer. And that means they are subject to termination of service provisions if the consumer does not pay their bill, but following all of the normal and customary regulatory processes that occur of providing consumers notices of termination and allowing them to enter into deferred payment arrangements. The installment charge that is billed to the customer, if the customer makes a partial payment on their bill, the legislation provides that the payments are first applied towards the consumer's utility service charges, and then secondly towards the application of their on-bill recovery financing installment charges. Our loans are transferable. The legislation requires that prior to sale, a seller has to give written notice to a prospective purchaser. And the legislation says that unless that charge is satisfied prior to the sale, then the charge shall survive change in ownership, i.e. it'll appear in the utility bill of the purchaser of the property unless it's been previously satisfied. Now, because of that feature, it doesn't mandate that the charge transfers when the property is sold or transferred, but rather allows for it. And so because of that feature, it requires something called a program declaration to be filed in the county or city recording office in much the same way as a mortgage or a property easement would be recorded. Its purpose isn't to place a lien on the property, but rather to provide notice to a prospective purchaser of a property of the existence of the on-bill recovery financing mechanism. The program first was launched to authorize eligible energy efficiency improvements, and through subsequent legislative amendment included PV and other net meter technologies. There is a cost effectiveness requirement that is effectively a bill neutrality rule. It provides that the anticipated energy savings have to be equal to or greater than the charge that will be repaid back over the bill. But importantly, that's measured by looking at all of the energy fuels that the consumer has. We have our other smart energy loan has a less restrictive cost effectiveness rule, which is effectively a 0.8 SIR over the useful life of improvements. The legislation provides for the payment of fees to the utilities to cover their administrative efforts. They're paid $100 per loan plus 1% of the amount of each loan. There are strong consumer safeguards built into the program. There's required notices that are provided to the consumer prior to closing of the loan that ensures that they're aware of the obligations of the loan and what can happen if they don't fulfill their obligations. And it also spells out complaint handling procedures if they're dissatisfied with their clean energy improvements. There's an annual billing notice that's included in their utility billing to summarize the status of their payments. And all of the program is subject to the oversight of the State Public Service Commission, who can monitor levels of arrearages and any disconnections and adjust the program accordingly. Roles and responsibilities. So NYSERDA's role here is program administrator and ultimately the capital provider. We have a third-party loan originator, Energy Finance Solutions, which is named Wisconsin Energy Conservation Corp. They are the entity who actually processes credit applications, issues loans, and disperses loan proceeds to contractors when work is complete. The role of the utility, importantly, this picks up on John Michael and Mary's points, utilities didn't want the role of being lenders. They don't want to be lenders. They don't want to be loan servicers. And both in our statute and in contractual relationships that we have with each of the utilities, the role of the utility is made clear to be responsible for the collection of a charge that has been authorized by their customer through a loan agreement that they've entered into through the program. They perform follow-up on collections in accordance with their normal procedures. We have a master loan servicer entity, Concord Servicing Corporation, that reviews a sample of loans to ensure that they meet our underwriting standards, and they are ultimately the entity that exchanges information and money with each of the 7 utility companies on a weekly and monthly basis. And then lastly, we have a title company that performs an owner search of the property records and records the declaration instruments working with the county clerk's office. The terms of our financing offer loan terms of up to 15 years, can't exceed the useful life. When our program was first launched, financing was offered at a rate of 3.49%. The program was very successful, and ultimately our program was requiring additional funding from REGI funds. And because those funds were limited, and because we wanted to ensure that the program could continue to serve predominantly lower to moderate income consumers, in September of 2016, we revised the interest rates of the program, and we established this tiered interest rate structure where we're continuing to offer lower and subsidized interest rates to lower and moderate income consumers, but consumers who have higher household income levels are offered interest rates that reduce or eliminate any subsidization that's required from the program. So you can see here the rates now go up to 7.99%. For solar loans for consumers whose income is greater than 120% of county median income. There are fees that are charged to the borrower. There's a processing fee of $150 that can be included in the amount that the consumer finances, and NYSERDA pays a fee to the loan originator that's ultimately funded out of the interest rate that's charged to the consumer. Our loan underwriting standards are set forth in this slide. We have two what we call tiers of loans. Tier 1 loans use fairly traditional unsecured consumer lending. So it looks at a minimum credit score of at least 640 and ensures that the consumer doesn't have a debt to income ratio greater than 50%. We also have more flexible Tier 2 underwriting standards that allow consumers with lower credit scores, higher debt to income ratios, maybe having had a bankruptcy more recently, to access financing. And overall, currently about 25% of the loans that we're issuing are issued to consumers who meet this Tier 2 criteria. So the funding for our program initially was established out of monies from the Regional Greenhouse Gas Initiative, or RGGI, and we've provided additional monies today that are used to fund our revolving loan fund. But the revolving loan fund really just funds loans when they're first originated, and then we then aggregate those loans and refinance them through capital markets financings. Our energy efficiency loans that meet our Tier 1 underwriting standards have been refinanced through a collaborative effort with the state entity who administers the state clean water revolving fund, state revolving fund. And in 2013, we issued about $23 million in bonds that was secured by a guarantee from the Clean Water Fund, and it allowed us to access AAA rated capital to support the refinancing of those loans. Subsequent to that, we've done 2 more years of bond financing, working with EFC, who's the administrator of the State Clean Water Fund, and continuing to allow us to access AAA rated capital. The solar loans, the residential rooftop solar loans that have been made through the program, haven't qualified for the same use of SRF financing. And so in 2015, we secured a $50 million private placement credit facility with a regional bank, M&T Bank. And through that, we were able to refinance a pool of residential solar loans. And we are currently working on a bond issue that would be a publicly issued, publicly rated green bond to refinance additional Tier 1 residential solar loans that we expect to close on by the end of this year, and that'll likely be up to $25 million. The Tier 2 loans that I mentioned earlier aren't initially pledged as part of these refinancings bonds, but instead they're held until they have a repayment history, which is about a 5-year period that could allow them to be included in a capital markets financing. So the next slide summarizes the status of our portfolio. So in the 5 years that our on-bill financing program has been in existence, we've issued over 7,200 loans across the state of New York, totaling about $100 million. You can see the statistics here on the average term, interest rates, credit scores, debt to income ratios, and you also can see the comparable statistics for consumers who have accessed the unsecured off-bill smart energy loans. So the next slide summarizes the performance history of our portfolio. I've summarized both the delinquency rates and the charge-off rates. By charge-off rates, I mean loans that are more than 120 days past due. One thing you'll note is that both the delinquency rates and the charge-off rates are a little higher for the on-bill loans than they are even for the traditional unsecured consumer loans. Part of the reason for that, it relates back to the requirements of the statute that provide that partial payments on the bills are first applied towards the application of utility service charges. So we think that ultimately this is more of a timing issue, more so than a representation of cumulative expected defaults that we'd see on the on-bill recovery loans. So last slide, some lessons learned. We believe that on-bill recovery financing has the potential to be a highly scalable, highly efficient financing mechanism and offers customers convenience by allowing them to make investments in clean energy and pay those back through the same charge that they're already paying for their utility services. Termination of service regulations have surprised some that termination of service provisions were used here in New York State. But I would say that because of strong underwriting standards, the program hasn't had any shutoffs to date in the 5 years that the program has existed. But it's an important feature that was built into the legislation that would support an effective capital markets financing approach. However, the subordination is problematic for secondary markets financing. The fact that, as I mentioned earlier, I think we have some delinquencies and even longer delinquencies that are the result of some customers being on deferred payment arrangements with the utility company, whereby all of the payments that they're making pursuant to those arrangements are being used to satisfy utility arrearage balances. We think there's a potential to engage private capital or third-party capital at scale, but in order to do that, we'd have to deal with establishing a parity of collection between the utility service charge and the customer's on-bill recovery installment charge. But if that were done, utility financing can be highly efficient because overall utility companies have a long track record with millions of customers that can be used to support the fact that the default levels, the expected write-offs would be far lower than any other form of traditional consumer finance. One other lesson that we've learned is the transferability mechanism of our program hasn't really been all that effective. The owner search process takes too long, the fees are too expensive, lenders have been confused when consumers go to sell or transfer their property, and overall it appears that it's only working about 25% of the time. It seems that 3 out of 4 times on-bill recovery loans are being paid off rather than the charge being accepted by an incoming customer. And so instead of going through all that time and expense, one option that we've considered is allowing for something more like a voluntary transfer or an assumption by a purchaser. And then my last lesson that I think we've learned is cost effectiveness or bill neutrality really can limit the ability to get to scale. In our program, our Home Performance with Energy Star comprehensive program, about 80% of the consumers like the feature of an on-bill recovery loan, but only about 20 or 30% of consumers' projects qualify based on that bill neutrality. And while absolute bill neutrality is important, if not essential, for certain protected consumer classes, perhaps like lower income consumers or maybe the elderly, there could be consideration given to allowing consumers to make smart, informed choices to install and finance qualified higher efficiency measures, but ones that not necessarily provide for a strict repayment over the financing term of those improvements. And so we're hopeful that there could be some consideration in the future to modify the provisions of the program to allow even more consumers to access on-bill recovery financing. My contact information is here. We're happy to share our documents, our processes with any states who might be thinking about on-bill recovery financing, as well as sharing performance data, anonymized performance data of our program. And with that, I'll turn it back over to Sam. Thank you.
Great, thanks, Jeff. Appreciate that. It'll be interesting to see how you get your work in getting those private capital providers involved in the market more. So we have about 4 minutes left. I'd like to just open up the floor to some Q&A. I see one question here in the queue from Ken Hughes. This is for Mary, asking if Michigan is seeing a lot of interest in solar these days.
So yes, we are seeing a lot of interest in solar. I think that there was a perception that it's just too darn cloudy in Michigan to make solar effective, but with the cost of the panels going down and certainly the longer loan terms that we offer, and with on-bill, if we can get up to 15 years, our solar contractors are very, very busy, and we're seeing. We financed 1 megawatt of solar in both the residential and commercial space, and that represents just a small portion of the marketplace. But yeah, we're seeing it grow pretty strongly.
Great. Let's check if we got any hands here. Well, I guess a question for me, really, I guess this is for all three of you, is, one of the things that comes up once in a while when you talk about on-bill financing is the ability of renters to use the program, since it's with the utility bill. Have you guys had any conversations around the use of having renters versus landlords in implementing on-bill financing, and how has that kind of impacted the discussion?
Sam, yes, go ahead, John Michael. Sorry, go ahead.
I'll just go real quick, guys. We've looked at a few different programs that do it. Some do it in different ways. It does seem to be a challenge in general, but with using transferability and bill neutrality, there have been a couple of programs that have been able to do it. We put together kind of a rundown of different methodologies for that and different examples.
Okay.
Jeff, have you been able, I'm curious, Jeff, have you been able to serve the rental market? And in the city of Holland, the way that they're allowing landlords to, it's only if they, the landlords actually pay the utility bill. That's the only way that they're allowing it right now. I know when I'm talking to the rest of the utilities, they're interested in that, but I can tell you we haven't figured it out yet. So if you've done it, I'd love to learn from you.
We haven't. I mean, as a matter of law, it actually can be done, but as you point out, the owner of the property has to be willing to assume that obligation when and if the renter leaves. And so I think in many instances, it seems unlikely that a landlord's going to be willing to run the risk of assuming those obligations during periods of vacancy of the property.
Great. And then we have one final question here from Jonathan Seawall. This is for Jeff. What are the policy drivers when looking at the possibility of not using bill neutrality with higher income customers relative to lower income residents?
Well, as I said earlier, I think that consumers who have higher income and have better credit probably are in a better position to fulfill their obligations. And so we think that there could be a conversation here about relaxing a strict and literal bill neutrality requirement for that class of consumers, while continuing to maintain that strict and literal bill neutrality requirement for consumers who rightly should have their interests protected and ensuring that they're going to have an ability to repay.
Great. So at this time, we are officially out of time for this webinar. I want to give a big thank you to all three of our speakers. Those are some really fantastic presentations. Definitely got a lot of great information about on-bill programs out into our audience here. For those of you in the audience, please join us for our next webinar that will be on Thursday, October 19th. We'll be focusing on public-private partnerships. So if you have an interest in PPPs, please tune in next month. And with that, looks like we're all set. So everybody, thank you once again for joining us, and we'll hopefully see you in a month.